Archax, tZERO, and HBAR are not just names in another crypto announcement. They are sitting right in the middle of a much bigger story: how institutional money may move from traditional finance into tokenized treasuries, through regulated rails, and eventually onto public ledgers. And the key date was June 23rd, 2026. You see, that was the day that tZERO announced that it would bring Archax's GOVY token to United States institutional investors. Not retail, not meme traders, not the usual crowd chasing a green candle. We are talking about qualified purchasers, regulated broker-dealer infrastructure, custody, tokenized short-term US Treasuries, and a product issued across networks including 𝗗𝗗𝘀𝗃. So the question is simple: why does this matter for HBAR? And it's because when traditional capital moves on-chain, it does not start with speculation. It starts with the safest assets in the world. It starts with treasuries. It starts with custody. It starts with compliance. It starts with the boring pipes. And those pipes are where the real story begins. On the surface, this looks like a clean institutional product announcement. tZERO, a regulated financial infrastructure company, asks Archax's GOVY tokenized US Treasury bill product will be made, available to US qualified purchasers through tZERO's SEC-registered and FINRA member broker-dealer and custodial setup later this year. Now, that sentence, it sounds very technical, but let's strip it back down, and it becomes much easier and much cleaner, right? Archax has a tokenized short-term treasury product. tZERO has a regulated US market access. Together, they are building a pathway for institutions in the United States to access tokenized government yield through a structure that they can actually explain to their legal teams, compliance departments, risk officers, auditors, and boards. That last one really matters, because institutions do not move like retail. Retail sees a token, checks the chart, checks Twitter, and then asks whether it can do a 10x. Institutions, they see a token and ask a very different set of questions. Who issued it? What legal rights does the investor have? Where are the assets held? Who handles custody? What happens if we redeem? What regulators are involved? Can our compliance team sign this off? Can our auditors understand it? Can our risk committees survive the meeting? Now that is the world that this announcement is speaking to. It's not hype, process. Not noise, permission. Not a flashy launch, a route into the largest addressable market for tokenized treasuries. And this is where the emotional trap begins to set for retail HBAR holders, because many people are watching price, but institutions are watching the rails. To understand GOVY, we have to understand what it is trying to represent, right? This is not a meme coin. This is not a loose promise of yield from some mystery strategy. GOVY is designed around short-dated US Treasury bills. Now, these are among the most trusted instruments in traditional finance because they are backed by US government and sit at the heart of the global collateral system. Now, banks use treasuries, funds use treasuries, governments use treasuries, money market desks use treasuries, collateral managers use treasuries, and the whole financial machine, it treats them as high-quality assets because they are liquid, widely accepted, and deeply understood. Now, take that world and then ask a dangerous question. What happens when that kind of asset can exist as a token? Not as a vague idea, not as a PowerPoint, but as something that can settle on-chain, be held in regulated custody, and move through permissioned institutional pathways. Well, that is the real story. Now, GOVY is described as a perpetual T-bill token. And in plain English, that means that the product is built to give continuous exposure to short-term treasury bills without the investor needing to manually manage each maturity cycle themselves. Traditionally, short-term T-bills mature. when then the investor has to roll into a new one. Now that process is normal in finance, but it is also operational work. It requires systems, people, permissions, settlement, reconciliation, and timing. A tokenized product tries to compress that workflow. You hold one token, underneath the exposure keeps rolling through short-term treasuries. Now that is not exciting in the way that a meme chart is exciting. It is exciting in the way that a bridge is exciting before a city gets built around it. Because institutional capital can move into tokenized treasuries through regulated channels, the next question becomes unavoidable. What other assets follow? So here is the question for you. If institutions start with tokenized treasuries, what do you think comes next? Money market funds, equities, real estate, or something much bigger? Now here is the part that most people miss. The villain in this story is not just another blockchain. It is friction. Friction is the old system's quiet monster. Settlement delays, custody complexity, jurisdictional risk, legal uncertainty, manual processes, walled-off markets. Assets that can trade in one place but cannot easily move into another. Documents that say ownership exists, but systems that cannot move that ownership at the speed of the internet. Now this is the deep dark hole that tokenization is trying to solve. And it is also why so many crypto projects will never reach institutions. Because being fast is not enough. Being cheap is not enough. Having a nice explorer is not enough. Having a loyal community is not enough. Institutions do not just need a network that works. They need legal wrappers, regulated entities, custody partners, whitelisting, permissioning, reporting, redemption mechanics, and clear accountability. Now that is why the tZERO part matters. A token can exist on chain, but if a US institution cannot access it through an approved channel, the addressable market stays trapped behind a wall. Now that wall is not technical, it is regulatory. So, when tZERO brings a product like GOVY towards US qualified purchasers through an SEC-registered FINRA member broker-dealer setup, well, the story changes, because the question stops being, can this token exist? It becomes, can regulated capital reach it? Now that is a very different question, and it is the question that serious investors should be asking across the entire RWA sector. Not which projects have the loudest community, not which founders give the best interview, not which token has the most dramatic weekly candle. The better question is this: where are regulated liquidity pathways forming? Because liquidity does not magically appear, it travels through pipes, and once those pipes are built, capital can start moving, at least to start to move, with far less resistance. Now, I do have to pause here for just a quick second to let you know that I'm not a financial advisor. This video, it is for informational and educational purposes only. The crypto market, it is volatile, and you could genuinely lose everything that you've invested. So it is very important that you do your own research, because at the end of the day, your money is your responsibility. Now, let's get back to the story, because this is where HBAR enters the frame. HBAR holders have been waiting a long time for utility to become more than just a talking point, and that wait has been painful. We have seen announcements, we have seen partnerships, we have seen pilots, we have seen the phrase real-world assets thrown around so much that many people now just roll their eyes the moment that they hear it. But GOVY gives us something more specific to track. Not just RWA adoption, not just institutional interest. A tokenized treasury product, issued across networks including HBAR, connected to a regulated platform in Archax, and now linked to US institutional distribution through tZERO. That is a trail, a real one. And for HBAR holders, the key is to stop thinking only in terms of immediate price action and to start thinking in terms of infrastructure gravity. See, here is what that means. If tokenized treasuries grow, they need networks, they need issuance, they need settlement, they need identity layers, they need compliance wallet controls, they need reporting, they need payment flows, they need custody relationships, they need assets that can be used, moved, pledged, redeemed, and accounted for. 𝗗𝗗𝗀 has spent many years positioning itself around enterprise-grade rails, low fees, fast finality, and a governance model aimed at large organizations. Whether the market appreciates that today is a different question. But the institutional world does not usually arrive all at once. It tests, it measures, it signs agreements, it checks risks, it starts with narrow use cases. Then, if the systems work, well, the volume can follow. Now that is why this story is not just about one token alone. GOVY is the visible piece. The deeper story is the route that it takes. Archax on the issuance side, tZERO on the US regulated access side, 𝗗𝗗𝗀 as one of the networks supporting the product, and behind all of that, a much bigger shift. Traditional assets being rebuilt for on-chain settlement. Short sentence, big consequences. The rails are forming. So, how do we track this properly? Because this is where retail often gets hurt, right? People hear institutional adoption and immediately jump to price targets. But the smarter move is to build a framework, a way to judge whether this is noise or a signal. First, we've got to watch the distribution. Who can actually access the product? In this case, the focus is US qualified purchasers through regulated infrastructure. And that matters because it points toward a serious investor base, not just open retail speculation. Second, watch custody. Right? Institutional investors care deeply about who holds the assets, how they are protected, and what legal claims sit behind the token. If the custody setup is weak, the products struggle. Third, watch issuance networks. Right? GOVY is being issued across Ethereum, 𝗗𝗗𝗀, and Stellar, which means that this is not a one-chain story. But for HBAR holders, the 𝗗𝗗𝗀 connection matters because it places the network inside a live institutional asset conversation. Fourth, watch settlement and redemption. A tokenized treasury product is only as useful as the ability to subscribe, hold, transfer where allowed, and redeemed according to the rules. Now, that works smoothly, at least if it works smoothly, confidence rises. Fifth, watch repeat behavior. One product can be a pilot, two products can be a pattern. Multiple products across money markets, treasuries, collateral, and settlement begins to look like a new operating model. Now that is where conviction should come from, not from hope, from evidence. And evidence in this sector is not always going to look exciting. Sometimes it looks like a regulated broker-dealer. Sometimes it looks like a custody stack. Sometimes it looks like a whitelisted wallet. Sometimes it looks like a token that represents treasury bills instead of a viral meme. Now that is the funny part. Like, the most important moments in crypto may not feel like crypto at all. They may feel like paperwork. So here is the question for you. Are you watching HBAR for short-term price action? Or are you tracking whether regulated liquidity is actually being built around the network? The revelation is that institutions are not waiting for crypto to become more chaotic. They are waiting for crypto to become more usable, more compliant, more auditable, more connected to assets that they already understand. Now that is why tokenized treasuries are such a powerful first step. A treasury bill is not hard for an institution to explain. A tokenized treasury product is harder, but it becomes, much easier when the product is tied to regulated entities, proper custody, whitelisted access, and clear distribution channels. Now that is the bridge. Not a bridge between chains, a bridge between the language of crypto and the language of institutions. And once you see it that way, the tZERO and Archax Announcement looks very different. It is not just another company is doing tokenization. It is a regulated route is being built for US institutional investors to reach tokenized government yield. Now that is the core. And for HBAR holders, the point is not to pretend that this guarantees anything. It does not. But there are still risks: execution risk, regulatory risk, market risk, demand risk, competition from other chains, competition from other issuers, competition from traditional products that do not need blockchain at all. But serious investing is not about pretending that risk is gone. It is about knowing what to watch. And right now, we are watching, at least what we are watching, is whether tokenized treasuries become a gateway asset for institutional capital on-chain. If they do, then networks supporting compliant issuance and settlement are not side characters. They become the part of the plumbing, and plumbing is easy to ignore until the whole city depends upon it. So let's bring this home. Archax, tZERO, and HBAR matter here because this story sits at a crossroads of three major forces. First, the demand for safe, liquid, yield-bearing assets. Second, the rise of tokenized real-world assets. Third, the need for regulated infrastructure that institutions can actually use. The June 23rd announcement is not the finish line, it is a marker. A signpost, a signal that tokenized treasuries are moving from concept to regulated distribution pathways. And for the HBAR community, that should shift the way that we actually think. Right? Instead of asking, why has price not moved yet? Ask, are the rails getting stronger? Instead of asking, when will retail notice? Ask, can institutions access the product? Instead of asking, is this hype? Ask, does this create a repeatable pathway for regulated capital? Because the next phase of crypto may not be led by the loudest assets. It may be led by the assets that can pass the most boring checks, compliance, custody, settlement, legal clarity, distribution, redemption. Now that is not the language of hype. That is the language of capital. And that is why we watch these announcements closely. Not because every headline is going to change everything overnight, but because the financial system is not built overnight. It changes rail by rail, product by product, market by market. And if tokenized treasuries become one of the first major bridges between traditional finance and on-chain infrastructure, then HBAR holders need to understand exactly what is being built, who is building it, and where the liquidity may travel next. Because by the time the market finally reacts, the rails may already be in place. And that is the real story. Archax, tZERO, HBAR. The institutional rails are forming. For now though, you can smash that like button, subscribe if you are new, and check out the video that is queued up on the screen. I will see you all over there.